Good morning, everyone. Thank you for tuning in for today's webinar. I'm Lian Seng, your healthcare and consumer analyst. So, earnings season is at full swing this week. Last week and for this week as well. So we will be going through 7 company results, which reported their results last week. So, without further ado, I'll start with HMI. So the main topic for HMI would be on its earnings being affected by one-offs. However, we still think that the growth drivers remains intact. As such, we maintain our buy rating with unchanged target price at 83 cents. So just to bring you guys through the results they have reported last week on last quarter. So on the top line, we can see that hospitals' contribution has actually grew 5.3% year on year. Its education business segment grew marginally as well at 1.4%. The hospital segment's contribution was mainly due to higher patient load from both hospitals in Mahkota, which is located in Malacca, as well as in Regency, which is located at Johor. So for both hospitals, we are seeing a higher average bill size as well, both coming from the inpatient as well as from outpatient. So these are the main underlying factors which drove the 5% growth in the top line. And as we screen through, its gross margin actually dipped slightly. It dropped 1.8 percentage point to about 32% due to higher staff costs. So they are on a recruitment So they are actually on a recruitment drive where they are getting more experienced nurses in tandem with their opening up of new wards as well as beds come in the coming quarter. In the last quarter. So they will be also adding another additional of 30 bed in each of the hospitals, which will be giving you a 14% additional bed capacity by end of the year. So with this, we think that the recruitment drive should continue throughout the year as they increase their new bed. So we think that margin would slightly be impacted by higher staff costs. And if we look down to, if we go down all the way to the PATMI level, so PATMI, they actually reported a net loss of 1.6 million ringgit. This is actually because of the FX impact as well as the professional fees and other costs relating to the consolidation transaction. So as you recall that they have actually completed their consolidation of their of the 2 hospitals, which is Mahkota and Regency, to 100% ownership. The transaction was completed in last quarter, and that actually registered about 7 million ringgit cost. And if we exclude that cost, right, we can actually see about 12% increase at the PATMI level. So moving forward, after the consolidation, we'll be seeing the earnings from these 2 hospitals to flow down directly to the PATMI level without seeing any losses or any leakage to non-controlling interest. So moving forward, we still expect that it will continue to garner more patient volume, as well as increase its average bill size on the back of the higher bed capacity as well as the new hospital extension block at Regency. So this new extension block at Regency, it would begin construction by end of the year, and the construction cost would be at about 160 million, which I'll talk a bit more later. So this extension would more than double Regency's current capacity. So as you know that Regency's current capacity is actually 200 bed. So as you know, by end of 2020 or even the first half of 2021, we'll be seeing a double of that 200 bed capacity. And the other concern of HMI's would be on its financial positions. So they took on a consolidation debt of 53 million Sing dollar. If you are asking why they actually took on Sing dollar debt, this is because that prior to the consolidation, prior to the consolidation, Mahkota and Regency wasn't fully owned by HMI, and thus it cannot be used as collateral to purchase the non-controlling interest, and hence HMI has to take on Sing dollar debt instead. So this amount to about 168 million ringgit, and with the current cash position of 121 million, and with the positive recurring operating cash flow of 20 million in each quarter, the company actually targets to pay down its consolidation debt by half by end of this year. So at the moment, as of last quarter, the net debt to trailing 12 months EBITDA is actually at 1 times, and its gearing ratio of 0.6 times. So it's not much of a concern. And as mentioned just now, we talk about the construction of the new hospital extension block. So they will it will incur another 160 million capex, and it will be funded via internal cash resources and bank loans. So overall, we are positive, and we are maintaining our buy call on HMI. So next will be Q&M. The headline for Q&M would be muted organic growth from clinics, and we have yet to see any new clinics coming online yet. And thus, due to a lack of near-term catalysts, we maintain our reduced call with unchanged target price of 65 cents. So if we go down to the individual business segment, you can see that its main revenue contributor is clinics business, grew at a marginal pace of 2.4% year on year. This is mainly due coming from the inorganic growth in Singapore, where you recall that they actually acquired 3 clinics over the year. And as for its distribution side, it grew at about 28.6%, coming from both its Singapore and China business. And as you recall that Idita was deconsolidated last year and is now contributing as an associate of the group. So the earnings from Idita will now come into the EBIT line. So that flows down to the revenue. If we exclude Idita's contribution in first quarter 2016, so just to compare apple to apple, revenue actually increased 4.5% year on year. This is mainly due to the higher contribution from distribution business. But if we look at the EBIT level, it actually dropped 16.9%. This actually has already included the earnings coming from editor side. Its EBIT margin dropped mainly because of higher operating costs, in particular of staff costs as well as rental expenses. This coming from the three new clinics which it acquired over the last year. So all these flow down to a marginal 3.6% unexciting PATMI growth. Recall that for the last results, the management actually mentioned that they are going to focus on expanding its clinic business in Singapore. They also mentioned that they target to open up 3 new clinics in Singapore by the first half of this year. But as of now, we have yet to see any new clinics. So we are still waiting for new clinics to lift the top line. If without new clinics, we expect that the clinic business growth will remain subdued. And sorry, and just to note that Housing has actually spun off last April. It has actually spun off in April, and will be reclassified as associate moving forward. So that aside, we look into the dilution of Editor's share. So just now I've mentioned that Editor now is being contributing as an associate at the EBIT level. So if you look at last year's contribution from Editor, it actually contributed about 52% of the group's profit before tax. And if we look at the first quarterly contribution post spin-off, is only recording at about 0.5%. So yeah, do note that this is on annual basis. This is on quarterly basis, but yet you can see that the dilution is actually actually had a very significant impact to the bottom line. And with that in mind, we'll be expecting a similar impact coming from the dilution from Housing. So with that, we estimate about 26% loss of combined recurring profits coming from Editor and Housing. And we maintain our reduced call with 65% target price. So next, I'll pass on the presentation to Peter, who will be talking about city developments.
Good morning, everyone. Peter here. So we have city developments first, and followed by Hock Lian Seng. Now, for city developments, first thing first, we maintain our accumulated core. Target price is $11.07. Last traded price was $10.58. So in the first quarter of 2017, revenue was up 8% to 784 million, and this was mainly due to the improved performance at the property development segment. And on the EBIT level, there was a net foreign exchange loss incurred in the quarter, which has dragged EBIT to $133 million, or 7% down, and followed by the profit before taxes, and it was dragged by about 17% or so, and this was because of higher net finance costs and the absence of contributions from JV projects. So the results were largely in line with what we have expected. So traditionally, for the first quarter, results are usually weaker. So but moving forward for the next few quarters, you can expect some form of earnings reversion there. So just to stay tuned for it. Now, let's get into the more juicy things. So for the within the quarter, there was a stronger take-up rate at Gramercy Park. So just to remind everyone, Gramercy Park is a 174 unit CCR development, or core central region development. So it was launched last year in May 2016. At the point of time, it's a bit more jittery because they only have like about a year or so to sell before they hit the QC extension fees, or due to pay the QC extension fees. So what came in as a surprise during the quarter was that they sold 90 units all in all right now. I mean, altogether they sold 90 units, and they've soft launched another 20 units. So 16 units at a much higher average selling prices, or ASP, came out to $2,800, which was much higher than we have expected. So if we what is to take away from this is that it's essentially a prelude for the price bottoming in the CCR segment, and this means two things here. First thing first is the opportunity to launch two new CCR developments. So they have South Beach Residences and New Futura. And of course, the next thing to note over here is that we've mentioned it in when we first initiated on CDL in November. They have the largest inventory among among all developers in Singapore. They have the largest inventory of CCR of CCR units. So when there's a market turnaround, CCR will essentially they'll be one of the first ones to first market segment to get the benefits, and we expect them to be the beneficiary of it. So still in CCR, what is the other thing that is interesting is that there's a lack of new launches, as we continue to reiterate. There's a lack of new launches in CCR, and this will definitely benefit New Futura's launch. So New Futura is a 100 over unit development in the River Valley area. So apart from New Futura, there's only another development left. That is the Martin Road development, which is owned by Guaco Land. So expect these two developments to come online, or essentially to be launched in the second half of 2017. So apart from these two, really there are no more planned developments. So the scarcity of CCR launches, you can expect a reasonably strong take-up. Because at the end of the day, I mean, we cannot expect take-ups to be something like Grandia Park Residences by Chip Eng Seng, when first day of launch, 70% gone. At the end of the day, these units, they are bigger in size, quantum is higher, so at the end of the day, the quantum, the prices to be paid is much higher. So what I mean by reasonably well is that we expect about a 25% take up rate for the next 4 years until it is completely sold. So for New Futura, you can expect 11 cents to be added to their RNAV estimates, and they will benefit. They are likely to benefit from the scarcity of new launches in the CCR segment. So recently they bought a new piece of land in Tampines Avenue 10, and as we did our own estimates, the estimated break-even cost is about 940, and match it with an ASP of $110 per square feet, it potentially adds about 10 cents to our RNAV estimates. So this will be different from CCR launches because they are smaller in size, so prices for each unit will be lower, and therefore you can expect the take-up rates to be, we are expecting a take-up rate to be strong from here. But apart from I mean, as of this point of time, because it takes about a year to obtain planning approval, or essentially it requires a year to apply for the for permits or to the regulatory approval, because before we can, or essentially before the developer can sell the property. So therefore the launch for this development can only begin, or the earliest that we can expect them to sell it is next year in 2018. So it's a rather timely launch in 2018 because there are two other nearby developments. They are the Alp Residences and the Santorini, which are already substantially, so about 60-70% there. So if we extrapolate this by 1 year, we expect these two developments to be close to or nearly completely sold, and this will really set the stage for this land for this new project at Tampines Avenue 10. Okay, I know I've continued to repeat about the two developments. One is Commonwealth Towers and Venue Residences, but there is also a reason why I kept doing that, because of of course, the thing to take note of is the ABSD deadline, as well as the potential price cuts that might actually happen in the two developments. So within these two developments, we were surprised by Commonwealth Towers. So if I bring everyone's attention to the chart at the bottom left here, this is the chart for Commonwealth Towers. So the bars over here represents the sales volume at the development on a monthly basis. So one bar over here represents 1 month of selling volume for that development, and the red line is the break-even cost, followed by this gray line over here is essentially the monthly average selling prices that were transacted in the development. So if we just look at April, the amount that were being sold within a month is more than the entire quarter between January to March. And we we expected it's indeed a pickup in acceleration in the demand. And we were, because initially our forecast, or what we've expected, is average selling prices to converge more towards the break-even prices, because they are nearing the ABSD date, and they have a lot of units, or essentially substantially unsold, essentially a quarter ago. So we expected them to cut prices, but on the contrary, what has happened is that we see the line over here diverging towards or essentially is moving the other way around. So what it suggests is that there were volume, at the same time the developer is also increasing prices. So it really caught us by surprise, and I think it's a good surprise. But for venue residences, it really was as per expectations. We expected them to cut prices. So right now at this point of time, it's very substantially so. There are still around 20 units or so, and they are, all in all, for these two developments, we are optimistic that they can clear all these units before the clawback of ABSD. So again, venue residences, ABSD deadline is September 2017. Commonwealth Towers is April 2018. So venue residences is about 4 months left for 20 units. So what they have to do is to just sell about 5 units or so until September, and I think that it's more or less a done deal already. And on the overseas and hotel segment, we are positive on China in the long term, but remain cautious on the upcoming GE. So in China, Hong Leong City Center is 77% sold already, and just waiting for recognition. And total sales value comes up to about 2.27 billion, or about 400 or 500 million Sing dollar. And the hotel segment, there was a one-off FX loss that dragged on its performance. So Millennium and Copthorne, it recorded a 50% drop in PATMI to about £3 million. So, but the thing to kind of take away from here is that global RevPAR is actually recovering, but this is except for Asia. And we just look at the chart over here in 1Q17, especially in two regions. First is London. It went up by 14.5%, and Australasia was up by 17.3%. And our view is that we expect global RevPARs to continue the recovery mode. So finally, we've come to the RNAV table. We've actually reduced the discount to RNAV to 15%, and this is mainly because of the story of the recovery in the CCR segment. So we reiterate again that we maintain our accumulate call. Target price is $11.07. Last price was $10.58. Next is Hock Lian Seng. Now, for Hock Lian Seng, they reported results last week. First quarter's revenue was up 19% to $28 million, but on the PBT level, because of the absence of contribution from a JV residential project, which was fully recognized since last year, therefore there's no contribution from on the JV level, and that has brought down the net income. Overall, results were below our expectations, but just hang on a bit from here, because we expect the new Changi Airport JV project to boost earnings in the next few quarters. So works at Changi Airport JV, the Changi Airport JV project, we expect them to intensify, or in other words, works to intensify in this project. And when works intensify, what it means is that it will contribute to higher revenue and of course a higher bottom line moving forward. And Changi Airport JV project is very significant for them because judging from the order book of 915 million, 70% of the order book is coming from the Changi Airport JV project. And just in this quarter, so what's different from this quarter and the quarter in 2016 is that contributions from Changi Airport JV project only they only managed to recognize about 5 million, and this project is worth about 600 million or so. And moving forward, you can expect them to ramp up works in this project, and henceforth they will be able to recognize a higher revenue moving forward. So this kind of this is basically it for the civil engineering segment. We will move on to the industrial property that they are constructing at this point of time. So they're constructing 174 unit B2 industrial property in Tuas, and it is on track to be completed in 2018. And at this point of time, sales remain weak. They managed to sell a few units at this point of time, but we can expect demand to ramp up or demand to increase moving forward, because the industrial space is essentially coming to a bottom. Or what we view is that the sentiments in the industrial space should improve moving forward. So, and because of that, we can expect more sales coming from Shine at Tuas, because the thing to take into perspective or to understand is Shine at Tuas, each of these units, the purchase price of them is not high, or in other words, one unit is about $200,000-300 grand or $200,000, essentially cheaper than a HDB flat. So affordability is not really it's not entirely the issue, but it's about the sentiments on the ground. So at this point of time, more than 50% of the property's development cost has already been incurred, and we believe that the remaining $60-70 million, the remaining of it can be funded with internal resources. There are more than adequate resources to fund the development costs. And when Shine at Tuas is completely sold, it will add about 6 cents to our RNAV estimates. So this is the valuation table for Hock Lian Seng, and if we add its value on the sum of the parts, or SOTP, we value the civil engineering segment at 23 cents and property development at 90 cents, followed by a net cash per share of 25 cents, which brings us to a fair value of 57 cents. So for Hock Lian Seng, we have upgraded our call to accumulate, and the new target, we maintain our target price, apologies. So the target price is 57 cents, matched with a last price of 47.5 cents. And with that, I'll pass the presentation over to Wang. So we'll be talking about Ezion.
Hi, it's Guangzi here. So Ezion announced their first Q results on last Friday. Our title is Endure the Stretching Drought. So we upgraded our rating from accumulate to buy due to the recent sell down, and the last Friday's close price was sorry about the typo here. So the last done price was 31 cents and our target price was 40 cents. So if you look at the financials here, actually the worst performance in first Q was mainly due to three reasons. Firstly, the charter rate didn't improve in first Q, similar to third Q or second Q of FY16. Also, the utilization rate of the whole fleet was dropping. The management expected by second quarter of this year, there will be 16 units under operation out of the whole fleet size of 26 fleets. And also, due to the unrealized FX losses, because the previously because the SGD was strengthened in first Q of this year. So first quarter Ezion's was actually loss making on the bottom line. So moving forward, the outlook of the rest of this year will be that the lower charter rate as well as the utilization rate will remain until third quarter or fourth quarter of this year. And also the expectation of strong US dollars is fading now. So possibly Ezion will be impacted by the FX losses in USD borrowings. And according to the management, there will be one unit. Supposedly, there will be 2 units to set to be deployed in Middle East. However, the clients requested to postpone the delivery. So right now we can see the market is still under pressure now. So and also the clients also stretch the window of delivery after upgrades and maintenance. So in second quarter, Ezion still face challenge. The next is China Everbright Water Limited. Our title is major turnaround this year. So we downgraded our rating from buy to accumulate with slightly higher target price to 57 cents compared with last time price on Friday, 48 cents. The top line revenue went up by around 18% to 774 million Hong Kong dollars. This was due to the more secure construction contracts in first Q. We will elaborate later because in April, China Everbright Water secured the big contract, the integrated project in Zhangqiu district in Jinan City. Also, the gross profit went up by around 10%. However, the gross profit margin was dragged down due to the lower margin in construction services. Usually, the gross profit margin from construction services was around 15% to 20%. So the bottom line net profit went up by 22.5%, was because the absence of FX losses in first Q of this year compared with significant amount of FX losses due to the borrowing pegged to USD last year. So when it comes to the Zhangqiu integration project, the total investment value will be at around 3 billion RMB with the capex per annum average at around 400 million RMB to 500 million RMB in 5 years in a row. So there are 3 components in this concession project: the management contract, BOT projects, as well as TOT projects. So for the rate of return of the BOT projects was estimated to be 5.1% without average. It is actually lower than the previous the management mentioned the IRR target, which was 8%. Because if you can take a look at the announcements, these BOT projects actually comprise quite a few construction work, such as the pipeline, the water supply facilities, all these. So the margin will be lower than expected, but we think that the rate of return at this level is quite fair because the severe competition in the utility sector in China at this moment. So the catalyst for the TOT project is that once the Everbright Water take over the project, it have the intention to hike the water tariff in Zhangqiu district. Currently, the average water tariff in Zhangqiu district was 2.4 RMB per ton. So compared to the Jinan city, because Jinan city right now is conducting the progressive water tariff scheme, so the first letter of the water tariff in Jinan city is around 4.2 RMB per ton. So actually we can see the upside of the water tariff hike in Zhangqiu city in the foreseeable future. Also, this integrated project includes the clawback provision, which is that if the tariff hike or the repayment fail to meet the contracted level, the local government will utilize or leverage the fiscal subsidy to repay the receivables. So here are the updates on the receivable issues. In the first Q of this year, the group's repayment rate was reported as 74%. This repayment rate is the measure of the actual payment that collected from the local government from the contracted payment. So this rate was similar to that in first Q of last year. And also the management guided that there will be the seasonality in Jinan's projects, and for Jinan's project, the weight of Jinan's project in the overall portfolio is quite large. So the payment term from this Jinan project is semi-annual rather than the contracted quarterly payments. The last one is that the Dongda's projects receivable issues, because the market concerns that whether the company can actually collect it, the receivables from the local government, because the management previously mentioned that the local government tried to use the assets to repay part of the amount of the receivables. However, this plan may not work as they guided in this quarter. However, they will try to solve this problem partially by leveraging the subsidy fund granted by the central government to pay back this amount. However, these solutions are not finalized yet, so we need to wait and see whether there will be actual plans on the collections of these receivables in the rest of this year. The next, I will hand over to Jeremy to talk about OCBC.
Morning. Okay, so for OCBC's first quarter results, as we have expected, there's actually a flat net interest income growth. The beat in the results came mainly from the insurance business and as well as the wealth management business. So on quarter-on-quarter, the wealth management and insurance business were up about 20%. So that part actually beat our expectations. And year-on-year wise, the allowances have been roughly flat, while the expenses have moved up roughly in line with the total income. So moving forward, what's the main theme will be, we expect stiff competition. We see the OCBC's regional corporate business facing at least one facing competition from at least one large universal bank. We suspect this will be from HSBC because it's driving similar product strategies in similar markets in Hong Kong, in the Pearl River Delta region, as well as Singapore. So, but we also feel that OCBC would be aggressive in maintaining ample deposits in both USD and SGD. As we saw in this quarter, we did see a spike in USD loans as well as in its business segment, more loans to its financial institutions. And what we mean by financial institutions here is actually the parent holding company that is registered in Singapore, but these loans that's given up to them would be distributed out to the subsidiaries for regional expansion. Then next would be the NPL. NPL is stable at 1.3. So the deterioration in collateral values for OSVs has decelerated. That is quite in line with the overall industry. And those oil and gas customers whose loans have not deteriorated is because they have diversified businesses. So that portion has to be monitored moving forward into this year. That could maintain on the positive level, or it could worsen. This is something which none of us will know at the moment. So moving ahead, we will still think that the net interest income growth would be flattish owing to unfavorable loans growth and volume dynamics. Loans volume and rates dynamics. So therefore, we maintain our reduced rating at the target price of 848. The last price now for OCBC is about 1050, 1060. Thanks.
There is a question asking about why I initiated a buy for Ezion so far, because we think that the current price level was because the due to the sell down, the probably is oversold for Ezion. You can take a look at this, because so far Ezion has secured for the bank credits facilities. So based on the liquidity side, it should currently is fine. And the other thing is right now the market still quiet, but the clients didn't default on the charter rate or cancel the contract. So our opinion is that we should wait and see whether the oil price recovery can actually pull up the charter market.
Okay, hello. This is Jeremy. So we have a question with the on the Singapore banks. The question is, with the anticipating of more interest rate hike and the bank's price to book is not that high, would the outlook of banks be good? And should OCBC have a higher target price? Okay, so I think the first part to the question, anticipating of interest rate hike. So I came out with the sector report in January, speaking of the challenges of loan growth and net interest income growth. So one of the things that in that report, the main thing is that the Singapore banks, or I should broaden that group. It is basically most of the Asian banks are moving into this cycle of high loan to deposit ratio. So I think this is one characteristic which will impede their potential to grow the net interest income if interest rates were to go higher. So what is going to add to the total income growth will be, as we have seen in the first quarter for all three banks, is the wealth management business and some of the other non-interest fee generating segments of the business, which is for some of them is actually the trading income. But the problem with wealth management business or insurance business or trading income is that they are very market driven and very sentiment driven. While on the other hand, if we look at net interest income, they can be driven by asset liability management, and they can apply strategies like treasury management to help increase the net interest margins and therefore increase the net interest income. So the price to book is not on a high side, so that is a good point. So if let's say we look at the share price of the banks, then we have to compare them with the from an international basis, because it's looking very much like a beauty contest, right? So beauty contest, in what I mean is that if you look at what the Singapore banks are, they have good quality assets. They can have higher than peers ROE, higher than peers return on asset, and also at the same time they can also maintain a comfortable level of risk-weighted assets, right? Which means that their CET1 ratio will be at quite a good level compared to the RWA. So compare this with what you see in Europe, right? Some of the other banks, maybe like Deutsche Bank, Credit Suisse, they're facing some legacy issues on their assets. Then if you look at some of the American banks like Wells Fargo, which has the problems with their the way they conduct their business, and therefore they are now cutting costs. And then if you look at also recently the Australian banks, which the government has imposed a levy on the liabilities, which will imply that the cost of operations will go up moving forward. So you are seeing that the other banks in internationally are facing issues, while Singapore banks are relatively unscathed, except for what we had seen in 2016, the oil and gas episode, but that has more or less subsided already. So in that sense, qualitatively, the banks could have an upside on that. But the problem is, when will anything unexpected come in on the macro side that would drive the share prices down? Because on valuation wise, if you look at the fundamental picture versus the share price, is indeed not catching up. So it leaves very much all the room to whatever that's happening on the institutional flow. So if the institutional flows were to see that probably the other international banks are making better progress, then they could move over and shift away from the Singapore banks. So my target price is actually quite conservative, and is more on the it appears to be bearish, but it doesn't mean that something is bad or whatsoever. But it's just purely on the conservative side. Thanks. Okay, looks like we do not have any more questions. So thank you for attending the webinar, and see you next week.